me bring on board, big guest on the show, Feroze Azeez, Deputy CEO at Anand Rathi Wealth. Feroze, great to be chatting with you this morning. Let's focus in on the outcome of the SEBI board meeting. Of course, the new, expense ratio framework introduces a base expense ratio which excludes statutory levies, a clear win for investors. But has SEBI really done a good balancing act here? Your first thoughts on the outcome?
SEBI has done a wonderful balancing act because there are four stakeholders. One is the investor, asset management company, distributor, and also brokerage firms who give brokerage services to these. So four stakeholders are there. One biggest difficulty, I personally think investors are not too worried about a 3 bips cut in expenses because they've already been rewarded with a direct option, which is 70 bips cheaper than the regular option in most schemes. That too for the last 12 years. It's not a new phenomena. It's a popular phenomena that an investor can go direct. But if a person wants to pay a distributor, he's actually smart enough to realize that cost is not the game to play, value is the game to play. That's why he's in regular in the first place. So discouraging expansion of distribution network of an asset manager or of mutual funds, which is just 2% of the US mutual fund industry, discouraging distributors is not a great thing. If let's assume cement as an industry, currently I think if you have so much more cement to sell, you want a larger distribution network rather than kill the distribution network. So I think SEBI understands that, investor understands that. Second, but transparency was lacking because it's very difficult to calculate the statutory levies, which are variable cost. Right, brokerage can be dependent on how much churn the fund manager does. How does an investor find out? So AMCs will have marginal impact, 1, 2, 3 bips. Distributors could have 1, 2, 3 bips, and brokers again could have 2, 3 bips of brokerage reduction. Is the current balance. Of course, the brokerage firms have been disappointed because they were earning only 7, 10 bips, out of which you take away 3, they lose 30% of the share, which is, I think, a little more discouraging. But I think it's a good balancing act to answer your question, Nandita.
Okay, good balancing act. But let's talk about, of course, it will have impact on AMC earnings as well. Profitability margins, would that be squeezed? How AMC stocks are rallying in trade today, but overall, in terms of earnings, what is the kind of impact you are envisaging?
See, if you look at SEBI's last 5 consultation papers or 2 mutual funds, you see the consultation paper is far more scarier than what actually gets enacted. That I think has now, to my mind, I decipher that as a strategy rather than a giveaway. Because they always expect an industry body like AMCs, brokers to actually represent. So they come with a certain narrative, they reduce it. That's why today you see a rally in most of the stocks because what was provisioned was on the basis of consultation paper. That's on point 1. Point 2, I think AMC's profitability is going to be largely dependent on not this 1, 2 bips. It's going to be dependent on how penetration of mutual fund happens. Today, we have more demat accounts selling and buying shares than mutual funds, which is so illogical. Right? There are fewer people trained on direct equity, but there are more direct equity investors than mutual fund guys. I think today we are getting 40-50,000 crores per month. The potential, to my mind, is 1.5 lakh crore per month in the next 3 years can come as net flow. If that is the expectation or that's the objective, then what you earn on your current assets becomes a lesser priority. It depends on how much growth will you get. I'm envisaging at least a 25% growth in net flows over the next 3 years, which at least means 1 lakh crores of per month inflow. Now, if that's the case, I think compromising on 1-2% on the current assets is a very, very fair price to pay for long-term greed.
Also, tell me, could this lead to a consolidation in the mutual fund industry or perhaps a shift in how AMCs really distribute products?
I think anything which has 2%, 3% in impact in the revenues will not change the industry structure. That's my firm belief. Anything which has more than 15%, 10 to 15% change in the costing and the revenues, you requires a new going back to the drawing board. So I don't think the consolidation or the fragmentation of the AMC industry will be largely catalyzed by this decision. Having said which, there has always been consolidation in the AMC industry, which is happening. And I think that will get a little more impetus, but this will not completely structure of the industry.
Okay. And, how should one reassess MF choices after these SEBI changes? Any categories that stand to benefit more?
Nandita, I think no, because all these changes you see are specific to all schemes, irrespective of what category they fall into, diversified sectorial. Having said which, then we tried to do mathematics to see whether a large scheme has a larger impact or a small scheme has a larger impact. There also we simulated a 10,000 crore scheme and we simulated a 50,000 crore scheme. Both of them came in the range of 5 to 9 paisa total reduction in cost for an investor. So to answer your question, the differential benefit passed on to any category seems negligible and by incidence rather than by choice.
All right. Also for brokers, when the proposal first came out, it was feared that the brokerage cap could be brought down to 2 basis points. But of course, the reduction is much lower. It's brought down to 6 basis points. Of course, SEBI has also approved removing additional 5 basis point charge to MF schemes with exit loads. Should this be viewed, more as a relief than disappointment from a brokerage industry point of view? And, of course, stocks have corrected quite a bit since that proposal came out. So, good time to look at this end of the capital market play?
Yes, see, firstly, the 12 bips and 6 bips, if you spend 30 seconds on that number, I think those numbers are not comparable. 12 bips was including statutory levies. If you read that, if I'm right, 6 bips is without statutory levies. If you look at the same proportion, that means they have reduced it from 12 bips to 8.3 bips. That's my math, give or take. So the reduction is about 28% of the current earning, or somewhere there, about 23% of current earning. That, to my mind, could have been let gone by SEBI, because you look at brokerages give a huge advantage to asset management companies. You see in countries where they've made brokerage negligible, the extra return which the fund manager is getting over benchmarks has come down dramatically. Because today there are 30 brokers serving one fund manager. Fund manager is like a king, like Durandar type, right? Uske aaspaas sab log ghum rahe hain, right? If you take that away, will there be any impact on his performance? I personally think there will be. Time will tell. But 12 bips down to 8, 8.3, not down to 6, because 12 included statutory levies, 6 plus statutory levies is the current proposal. Then you had a very, very interesting, again, important question, which is 5 bips on the lieu of exit load. This was one of the biggest anomalies in the expense ratio. Exit load, pehle, what used to happen was, if there was a fund investor exiting the fund before the exit load period was over, let's assume 1% within 1 year, the 1% paid by the investor used to go into the profit and loss statement of the AMC. AMC used to get richer if an investor went out before time. Now that didn't make sense. So SEBI said, okay, you have to add it back to the fund, not to your P&L. When this happened, there was some retaliation and some representation. So SEBI said, okay, charge 5 bips on the entire assets. That was like a painkiller given. That painkiller was like 5 bips on the lieu of exit load on the total assets, which are staying back. Itself is an oxymoron. That got corrected, which had to happen sooner than later. And that might have some impact on distributors of 2-3 bips and 2-3 bips on the AMC.
Okay, that's really well explained, Feroze. Just a few more questions on this topic. Of course, there have been incentives that are now allowed in public issues for select categories. Does this change how debt issuances may be priced or marketed? And will that, of course, evince more interest in terms of debt issuances as well going forward?
Yes, Nandita, it will. If you give a little extra interest rates for senior citizens, you always see Indians get attracted to small discounts given in terms of bond price or any incentive given to somebody. People grab it. So that's human psychology and largely also Indian DNA. So will that create penetration of the bond market of retail senior citizens? The answer is yes. But do I see it as a good news? I see it as a bad news. Because to analyze debt and buying debt directly, you need to do a lot more homework. You can't just go with credit rating agencies ratings, because the kind of companies which have gone default, they were not rated almost default 6 months before. They were rated AA, AAA also, just 3 months before they went default. So I personally think a debt is a far more complex asset class than equity. Because if in debt you go wrong, all your money is gone and it never comes back. In market, 10% of your money is gone, and if you just stay quiet, it comes back. So it's a binary risk in debt. So I don't believe that anybody in India for 50 bips, 1 bip spread should put his retirals in a bond which they don't understand Z scores and ratings clearly. That's my firm belief.
Okay, that's a negative, of course, according to Feroze. But Feroze, what happens to smaller funds? Do these are these caps negative for smaller funds who do not have access to extensive research reports?
I think, today brokerage houses serve most of the funds very, very equally. I'm speaking about the top 10, 50. Because brokerage is a unitized revenue, right? So if somebody gives a block of 5 crores, also he gets similar brokerage. So I personally think today brokers' attention concentrated of 5 was not such a popular thing. If a broker gets a lot which he needs to place with fund managers, he showcases to almost 20 people at once on Bloomberg screen, so that there is equal distribution of information. So I personally think small AMCs might not get a bigger disadvantage. If the consultation paper was actually put into act, then I think that definitely would have had a large disparity between the top 5 AMCs and the bottom 5.
Okay, got it. Lastly, on this topic, SEBI has also asked IPO-bound companies to file a summary of offer documents. A lot of other announcements as well in terms of IPOs. Anything that the investors should keep an eye out for, given the fact that we've seen such a tsunami of issues, and 2026 promises to be even bigger in terms of IPOs. Anything that investors should keep in mind with respect to what was announced in terms of IPOs?
Yes, Nandita, my take is a little different. Of course, the biggest change from an investor standpoint which comes up is the abridged version. Abridged version of the details of a company used to come with the RHP rather than the DRHP. So that now they're saying that you have to give the abridged version of your business with DRHP, which gives a little more time for an investor to study. That's a good thing for a long-term investor. But what is happening in India is most people are looking at IPOs as a transaction to be sold 2-3 days after listing. If that is the case, you have to look at demand and supply. How many times it is subscribed, what is happening in the grey market, then you put in your application. So because 80%, 90% of the volume of the share happens in the first 45 minutes of its listing. Most people change hands, except institutions. Most, by which I mean 80-90% of them have sold their share within 1 hour. When we got listed, I saw the volume of our share in the 1 hour was greater than what is the total free float given in the market in the first 1 hour. So I personally think Indians are using IPOs for trading gains rather than investing knowledgeably.
Yeah. That's true. And I don't know how many quarters of earnings are being discounted in the kind of rally some of these stocks are witnessing. You look at what's really happening with Meesho. In a matter of 5-6 sessions, it has literally doubled from its IPO price. But let's talk about the market as well. We are in the throes of a correction. No signs of FII buying, except of course for yesterday. But what is it looking like? Why do you think this correction is taking place? Do you think it's year-end adjustment that's at play? When do you expect this weakness to ebb? I mean, what is really happening especially after hitting record highs on the index level?
Yes, Nandita, what has happened to my mind is one thing which the market is missing is why is short covering not starting? when all the good news came, the GDP data was a positive. The repo rate cut was a good, pleasant surprise. At least 50% of them were not expecting any change. Still, with 91% of FIIs are short in index futures, the short covering rally is not starting. That is because in June, if I'm not wrong, SEBI brought in a circular which curtailed long positions in options market to 1,500 crore notional. After which, if you want to take any option delta position, not notional, delta position of 1,500 crores, you have to put cash and cash equivalent. Then there is zero leverage. Of course, so the point I'm trying to get to is, I was just wondering, 1 year back, if this would have happened, you would have seen Nifty touching 27,000 because the short guys would get caught. As soon as a 400-point rally, people are grappling to cover their shorts. That's not happening because one of the few countries which India is now, unfortunately or fortunately, of course, SEBI knows it very well. But I personally don't see that as a positive, to have long positions being curtailed. So where is the weakness coming from? The weakness is coming from derivative market curtailing of long position. One. Second, does it mean that the market will not gravitate upwards? It will, but not at the same pace it would have without this limitation.
Okay, got your point. So, what should one really do at the current juncture? Should one sit on the sidelines, deploy now? Is it a good time? On the index level, of course, we hit a fresh record. We've seen some correction, but broader end of the markets is where the pain really is. How should one approach this market?
The broader market, I think, is a good place to be now. Now, in the sense, in a couple of months, in 1 month, whenever you see pain in one of the segments which is deeper, those are the times where you exhibit courage to make long monies, right? In January, the broader market was partying, right? Then broader market became calmer. Then again, it did well. Now it is relaxing. When it's relaxing and the differential performance between Nifty and Nifty small cap or NSE small cap and mid cap has gone up 10% from their peaks, then I think building small cap funds and mid cap funds is not a bad idea. That's one. From a segment of the market participation perspective. Not today, maybe in a couple of months, if you stagger and invest, you're good in the broader market. Second is that always as an investor, don't get too perturbed with 4-5 days of correction, for which a trader is there. He's worrying, right? Let him worry. For an investor, you have to see 1 year of price correction. September, 1 year, 15 months of price correction ke baad bhi, if you're saying market should still be down and that's when I'll buy, then you're being a little on the trading on the path of greed. 1 year time correction, 15-month time correction, earnings have gone up 11-12% on Nifty 50 companies. Then you start building or build one lump sum also. I wouldn't be too perturbed doing that because next 3 years, Nifty delivering 12% compounded after a 1.5 years, 1.25 years of lull is upwards of 95% probable.
Right. Lastly, any pockets within the mid-cap end of the markets, within the mid-cap universe that has the potential to be a Rahman Dakat, if I may say so, since you mentioned Dhurandhar, I was reminded of Akshay Khanna's role. But anything that has a potential to emerge as a Rahman Dakat once the mid-cap party restarts?
Yes, Nandita. See, mid-cap is a very different universe. Low free float, $1 trillion free float, but only 150 companies. And every fund category, today markets are where they are because of domestic flows. So you have to see where is domestic flow possibly going. See, a multi-cap puts 25% in mid-cap, a small cap puts some money in mid-cap, a flexi-cap puts money in mid-cap, mid-caps itself put mid-cap money. So, and there are only 150 stocks. The large weights in mid-cap are always going to get benefited. Okay, so they will always have a 5-7 P greater than the industry comparable because of the liquidity they get. They absorb money from each category. So mid-cap is a good space to do bottom-up, especially heavyweight indices. So that's my take. Don't go sector-wise in mid-cap. Go more bottom-up, heavyweights, where influx of money is coming because that's what is keeping it buoyant.
Okay, got your point. With that, Feroze, would like to thank you for taking our time and joining in. But I hope we can interact once again before the end of the year. So I'm not wishing you Happy New Year just yet. I would like to do it next time when we chat. So thanks a lot for joining in, and I look forward to our next conversation as well.
Look forward. Thank you, Nandita.